this week's market update, sentiment is hit by a combative new mood at the White House, technology remains in the spotlight, and a new tax year changes the rules for UK investors. The investing backdrop has darkened in recent days as President Trump strikes a more confrontational tone on multiple fronts. First, he's escalated the unfolding trade war with China, doubling down on tariffs on $50 billion of Chinese imports, with the threat of a further set of levies on another $100 billion of Chinese goods. That was in response to tit-for-tat tariffs from China, which met the initial $50 billion tariffs with a like-for-like attack on US exports to Asia. The White House's chief economic advisor, Larry Kudlow, tried to ease tensions slightly last week by suggesting that the two sides were working behind the scenes to find a solution to the trade spat before tariffs actually come into effect. China, however, dismissed that claim as not the real situation, and a speech yesterday by Xi Jinping offered few of the hoped-for concessions. Washington said it took action against China following an investigation into Beijing's alleged theft of intellectual property from US companies. China routinely demands the transfer of intellectual property to Chinese companies as a condition of being able to trade in China. Now, many people who otherwise oppose Trump's aggressive approach on trade acknowledge that there is more than a kernel of truth in his allegations. The rapid escalation of the trade conflict between the world's two biggest economies has heightened market concerns about the risks of a full-blown trade war. History suggests that if the two follow through on their threats, there'll be no winners and plenty of losers. There have been many instances of damaging trade conflict over the years. Most notorious of these were the Smoot-Hawley tariffs of 1930, which applied US tariffs on 20,000 different goods. When Canada and other trading partners responded in kind, US exports fell by 60%. It's widely accepted that the tariffs deepened the Great Depression and had impacts well beyond global trade. President Trump has claimed that trade wars are easy to win. Well, time will tell whether workers in the most affected US industries agree. China has already shown that it intends to target its retaliation at the president's supporters, for example, via tariffs on soya beans, which are largely grown in Trump-supporting areas of the Midwest. The second fight picked by the White House this week has been with Russia on two separate fronts. First, the US has imposed a tough new set of sanctions on high-profile Russian businessmen with links to the Kremlin. The impact was immediately felt in the markets, where, for example, aluminium tycoon Oleg Deripaska's London-listed EN Plus and Rusal, an aluminium producer controlled by EN Plus, both saw their shares fall sharply. The impact widened well beyond the individuals and companies, with, for example, Sberbank, Russia's biggest lender, falling by 17% yesterday. The benchmark MOEX index fell by more than 8%, its biggest fall since the imposition of sanctions in 2014 after the invasion of Crimea, and the ruble fell by more than 4% against the dollar. The latest measures have frozen the US assets of the targeted individuals. They're said to be a result of Russia's actions in Crimea, Syria and Ukraine, and its alleged interference in the West, including its cyber activities. The sanctions follow the expulsion of dozens of Russian diplomats by the US, UK and other countries following the poisoning of former Russian spy Sergei Skripal. The other attack on Russia is specifically related to its intervention in Syria's civil war, and follows an alleged chemical weapon attack over the weekend. Trump said there would be a, quote, big price to pay for the Syrian regime and its Russian and Iranian backers if the reports of the alleged chemical attack were confirmed. Not content with these face-offs with its biggest geopolitical rivals, Donald Trump has also triggered a standoff with the world's richest man, Amazon founder Jeff Bezos. On the face of it, Trump's issue is with the e-commerce giant's compliance with tax laws, its impact on traditional retailers, and its relationship with the US Postal Service. Trump claims that Amazon is getting a free ride from the US taxpayer, thanks to its favourable last-mile delivery agreement with the Postal Service. But cynics believe his attack on Bezos is motivated by something else completely. They think it's really about the Amazon founder's ownership of one of the biggest thorns in the president's side in the US media, the Washington Post. Although Bezos owns the Post in a personal capacity, and there's no link between the liberal newspaper and Amazon, the president clearly thinks differently, and investors have taken fright. The value of Amazon has fallen by around $60 billion in the past couple of weeks, putting a significant dent in Bezos' personal wealth as well. The attack on Amazon is just the latest in a string of woes for the technology sector, which was the principal driver of the stock market rally through 2017, and which has been a major cause of the volatility which has afflicted markets over the past couple of months. Other tech stocks in focus include Facebook, which this week sees founder and chief executive Mark Zuckerberg testifying to Congress. He'll face stiff questioning over alleged data breaches, which led to Cambridge Analytica using the personal details of up to 87 million Facebook users for political advertising, both during the US presidential election and Britain's EU referendum in 2016. Facebook's share price has also taken a pounding recently, as investors have begun to question whether increased regulation and lower profits will be the inevitable consequence of the recent privacy concerns. Also in the spotlight this week has been Tesla, the electric car maker, which was involved in a fatal accident in California, recalled more than 100,000 cars over a steering fault, and missed production targets for its mass market Model 3. And finally, Spotify, the Swedish music streaming service, came to market last week with an unusual direct listing that avoided many of the costs of an IPO, but paid the price with a less controlled share price in early dealings. Having opened at $169.50, the shares had fallen to $146 by the end of its first week on the market. Spotify, like tech giant Netflix, is a jam tomorrow investment that promises great returns for investors, but short-term losses as the company builds its customer base. It already has more than 70 million subscribers, twice as many as its biggest rival Apple, but it's still trading in the red as it invests in growing the business. So, putting it all together, stock markets ended last week on a downbeat note, and investors continued to withdraw cash from US funds. These suffered outflows for a third successive week. So far this year, $38 billion has been pulled from US funds, according to data from EPFR Global. Now, interestingly, emerging market funds have picked up some of the slack, and that's despite fears in some quarters that a trade war might damage the growth prospects of the developing world, and more recently, of course, the slide in Russia, which had taken over from India as emerging markets investors' favourite market. Global emerging market funds have now taken money in for 15 consecutive weeks. Another beneficiary of increasing market nervousness has been short-term bond funds, which have enjoyed inflows for the first time in a month. These are particularly attractive in an environment of rising rates because they're less impacted by higher interest rates than longer-term bonds. Following recent Federal Reserve meetings, it's still expected that US interest rates will be on a steadily rising path for the next few years, although new Fed Chairman Jay Powell promised a patient approach to monetary tightening at his first external speech since his appointment in early February. Speaking in Chicago, Powell said that the US labour market was not, as he said, excessively tight. He also pointed to important longer-run challenges for the US economy, suggesting that the longer-term growth rate might be stuck under 2%. That's a far cry from the president's claims that growth could exceed 3% for much of the coming decade. That caution chimed with last week's non-farm payroll employment data, which showed just 103,000 new jobs were created in March. That was well below forecasts. The unemployment rate remained at 4.1%, and average hourly earnings rose by just 0.3% for an annual gain of 2.7%. So solid growth, but nothing for the Fed to be unduly concerned about. Inflation data later this week in America will probably confirm that prices are relatively contained. Now, on the corporate front, the main focus on this side of the Atlantic this week will be retail. Two big retailers are due to report, Tesco and WH Smith. Tesco, for long the dominant force in UK grocery shopping, fell on harder times a few years ago thanks to a string of accounting, quality and competition issues. It's bouncing back now, however, and last year returned to the dividend list. WH Smith has been a much better investment, benefiting from a dominant position in travel retail. Its airport and train station outlets have a captive audience and have grown strongly on the back of consumers' willingness to pay up while on the move. Over in the US, the banks are back in focus later this week as the first quarter earnings season gets underway. They are expected to have benefited from the recent rise in volatility, which is good for trading volumes. Last year's calm markets were, by contrast, bad news for the bank's trading desks. And finally, it's a new tax year here in the UK. That means early bird investors can put in another year's contributions to tax-advantaged savings plans like ISAs and SIPPs. Other less favourable tax changes include a reduction from £5,000 to £2,000 in the tax-free dividend allowance. Better news for graduates, though, who will only start repaying their student loans if their earnings are above a £25,000 threshold. That's up from £21,000.